Real estate investors, what I'm about to share with you could save you tens, even hundreds of thousands of dollars on your next deal. I'm Mariah Jeffery with Coldwell Banker, a certified commercial investment member, or CCIM. I'm not a CPA, but think of me as a tax strategy ninja trained to supercharge your real estate portfolio. Today, we're dissecting the one big, beautiful bill that just passed through Congress. We've all celebrated the reinstatement of 100% bonus depreciation, a topic I covered in my previous video. But for truly strategic real estate investors, the bill offers much more. We're deep diving into the Qualified Opportunity Zone program, comparing it to the tried and true 1031 exchange, and highlighting other critical tax changes you need to understand, optimize your portfolio, and yes, strategically minimize your tax liabilities. The One Big Beautiful Bill provides unprecedented certainty and powerful incentives, particularly through the extended and revitalized Qualified Opportunity Zone program. One of the key advantages of the QOZ program is that you can defer gains from a variety of assets, including the sale of stocks, bonds, mutual funds, real estate, cryptocurrency, a business, and yes, even your old Pokemon cards.
With the final signature here, the acquisition is complete.
QOZs are like the Avengers of tax breaks, revitalizing communities while slashing your tax bill. The Big Beautiful Bill makes them permanent, juices up incentives, and refreshes zone designations. So what's a QOZ? A QOZ must be in a census tract that meets one of these criteria: a poverty rate of at least 20%, a median family income below 80% of the surrounding area's median, or adjacent to a low-income area with other requirements. The goal of the QOZ program is to encourage investments in these areas that will ultimately result in revitalization, breathing new life into these communities.
It's wonderful to see so many people enjoying our shops again.
This revitalization has truly brought our community back to life.
Currently, there are about 8,700 QOZs, but the new bill kicks off the designation round July 1st, 2026 using updated census data. Expect tighter rules and higher income caps. Critically, the new bill eliminates the previous sunset date of December 31st, 2026 for deferring gains into other QOZs. This starts January 1st of 2027. This means you can defer your gains for up to 5 years or until you sell your QOF investment. But wait, I just threw out another acronym. QOF stands for Qualified Opportunity Fund. And to take advantage of the tax deferrals, you must purchase the QOZ property through a QOF. The QOF is the instrument that does the heavy lifting here. You have two options for investing in a QOF. The first one is to find an existing QOF fund. This does not involve purchasing a specific property, but rather a group of properties held within the fund. This is similar to the DST often used in lieu of a 1031 exchange, except the properties within the fund meet the QOZ requirements. And the second option is to create your own QOF using an LLC you already own or one that you create. Consider your LLC to be a caterpillar ready to morph into a tax-saving butterfly. But of course, there are several rules. To purchase a specific property through the QOZ program, you'll need to file paperwork to convert your LLC to a QOF. You must have a partnership or corporation, and at least 90% of the corporation's assets must be QOZ assets.
These opportunity fund rules are so complex.
No kidding, and we're just starting to get warmed up. Investors who purchase property through the QOZ program must spend significant funds revitalizing the property, equal to the adjusted basis after the land, and they must do so within 30 months. While the requirements may be strict, the benefits are many, so let's look at how much you can actually save on your taxes with the QOZ program. Beyond mere deferral, the QOZ program actually reduces the amount of the original deferred capital gain you'll eventually owe taxes on. If you hold your QOF investment for at least 5 years, 10% of your original gain is excluded. You'll pay tax on 10% less when it's eventually recognized. But rural super incentives provide a 30% basis increase. This is a game changer for rural development, especially in Wyoming, South Dakota, and Colorado, where I hold my licenses. But the holy grail is permanent exclusion of long-term capital gains. This is the most compelling incentive. If you hold your investment in a QOF for at least 10 years, any capital gains generated from the appreciation of that QOF investment itself be completely tax deferred. But hold the property for 30 years and it's like the IRS forgets you exist. The basis resets at that point, so everything you've invested in the property plus 30 years of appreciation can be cashed out tax-free. This provides unprecedented long-term certainty for tax planning. For seasoned real estate investors, the 1031 exchange has been a go-to for decades. Now with the enhanced QOZ program, you have another powerful tool. The question is, which one aligns better with your personal investment objectives? Well, one clear advantage of the QOZ is that the source of your capital gains is more flexible. They can come from stocks, bonds, mutual funds, the sale of a business. But with the 1031 exchange, it is only exchanging like-kind property for like-kind property. In other words, it only applies to real estate. With a 1031 exchange, the only way to completely eliminate ever paying capital gains is to die. That's right, when you die, your heirs inherit a stepped-up basis for your property, and they can then sell the property. Well, you never paid taxes on it, but you could never really cash out. You have to keep rolling and rolling one property into the next forever. And in a way, you may feel a little bit trapped in the scenario where you bonus depreciated your property, but then a few years later, all that depreciation has run out. And then what are you gonna do? Well, you have to sell it and buy another property. With the QOZ, you have options to never pay the taxes even while you are still living. So you can get out of this trap where you have to keep buying property over and over year after year. Of course, if all of your properties are triple net, then maybe you're not putting much time into it and it doesn't matter. But it's nice to know that you have a way out if you want one. Perhaps you would like to cash out tax-free and spend your money while you're still alive, as opposed to managing your portfolio till the day you die, only to have your heirs squander the fortune that you worked so hard to build. Stats show that 70% of wealthy families lose their wealth by the second generation and 90% by the third, so spend those QOZ gains now. While the QOZ is more flexible in where your gains come from, it is much less flexible in where your gains go to. With a 1031 exchange, any like-kind property is eligible to be your replacement property as long as it's for investment purposes. With a QOZ, you can only invest in your specific community impact zones. You must purchase the investment through a QOF fund, and requirements can be very strict. With a 1031 exchange, you can purchase the property in your own LLC or even in your own name, and you have direct control over managing the property. With a QOZ, you must follow the mandate for substantial improvement, which will revitalize the area and increase the value of this property. However, with a 1031 exchange, you can buy a property in whatever condition you wish and keep it in that exact condition. One thing that's actually more flexible about the QOZ than the 1031 is the timing. With the 1031, you have 45 days to identify your replacement property. With the QOZ, you have 6 months to purchase the replacement property and no deadline to identify. If nothing else, this makes QOZ a great plan B for a 1031. If after 45 days there's nothing good to identify, switch to QOZ. Both QOZs and the 1031 exchange are extremely valuable tools to have in your toolkit, so pick your fighter. But there are even more goodies in the Big Beautiful Bill, so let's touch on them briefly. Another substantial component of the Big Beautiful Bill was the expansion of the Qualified Business Income, or QBI, deduction. This deduction was formerly 20% for pass-through entities, and it has been made permanent and even increased to 23%. For real estate professionals and those holding investment properties in LLCs, partnerships, or even REITs, this is huge. It's a huge ongoing benefit that directly boosts your after-tax cash flow. As if that was not enough, we now have a benefit for the Section 179 expenses. This has been doubled from a $2 million deduction cap to a $4 million phase-out threshold. I expect to see a significant impact to the commercial real estate market between tax cuts that have been reinstated and even expanded, and interest rates that are finally starting to turn around. By understanding these changes and taking proactive steps now, you can significantly enhance your investment returns and build lasting wealth. As a CCIM, my expertise is in helping investors like you identify these opportunities and craft the precise investment strategy to achieve your objectives. So with these profound changes, How do you, as a forward-thinking investor, capitalize on these opportunities that have been presented to us? If you're a buyer client looking to leverage these changes, I invite you to reach out for a personalized consultation. Don't forget to like and subscribe to my channel for more real estate investing and more real estate tax strategy advice. Drop a comment below. What do you think is going to happen to the commercial real estate market in 2026?